Welcome back to Silver and Metal IQ. My name is Peter, and if you're watching silver prices right now thinking, what on earth just happened? You're not alone. Today's session was brutal, emotional, and extremely volatile. But here's the key question that matters far more than today's red candles. Did the silver bull market just break, or did it just prove its strength? Stay with me, because what we saw today actually tells a much more bullish story than most people realize. Silver had another wild trading day. Early in the session, prices were absolutely crushed. We saw heavy selling pressure that pushed silver sharply lower, shaking out weak hands and triggering fear across the market. At one point, silver dropped all the way down to $73.82 after trading as high as $79.30 earlier in the same session. That kind of move in a single day is not normal behavior for a dead market. It's the signature of a market that is highly contested. By the end of the session, silver managed to recover a meaningful portion of those losses. While it's still down on the day, about 1.7% to roughly 76.88. The fact that buyers stepped back in is extremely important. This is the first thing we can actually celebrate. When a market collapses and cannot bounce, that's when trends break. But when prices violently sell off and then stabilize, it tells us demand is still very real beneath the surface. To understand what happened, let's bring in the broader market context. According to FX's Street, silver traded lower in an otherwise relatively calm session. Moderate risk-off sentiment failed to provide support for silver, even as geopolitical tensions and macro uncertainty remained elevated. Precious metals as a group gave back some of the gains made earlier in the week, with one key exception: gold. Gold actually finished the day higher, up around 18s, trading near 4,175s, uncomfortably close to the psychologically critical $4,500 level. This divergence between gold and silver widened the gold-to-silver ratio to roughly 58.27. And while some traders may see that as bearish for silver, long-term investors understand something important. Historically, when this ratio stretches during bull markets, silver tends to play catch-up violently. Let's also be clear about one thing. This sell-off didn't happen in a vacuum. Markets are currently digesting multiple pressure points at once. Traders are focused on U.S. non-farm payroll data, ongoing geopolitical tensions involving Venezuela, and rising friction between China and Japan. On top of that, expectations around future Federal Reserve leadership and potential policy shifts toward lower interest rates are adding uncertainty. When uncertainty spikes, volatility explodes, especially in silver. Technically, silver briefly tested its 50-day simple moving average, a level that has acted as dynamic support since the uptrend began in late November. Momentum indicators have cooled, and yes, there is a possibility of further corrective movement. But corrections are not trend reversals. In fact, every major silver bull market in history has been built on sharp, uncomfortable pullbacks, just like this one. The most important takeaway from today is simple. Silver refused to collapse. Despite aggressive selling, despite negative headlines, and despite shaken sentiment, buyers stepped in. That alone tells us the bull run is very much alive. And in the next part, we'll dig deeper into the technical signals, physical supply dynamics, and why these dips may actually be opportunities rather than warnings. Now let's go deeper, because price action alone never tells the full story. To understand whether silver's recent move is a warning sign or a setup, we have to look at the technical indicators, and more importantly, how they behave during strong bull markets. First, let's address the volatility, because that's what most people are reacting to emotionally. Sharp, fast drops like we saw today tend to scare short-term traders, but historically, they are a feature of bull markets, not a flaw. Silver is one of the most volatile major assets on the planet. When momentum builds, silver overshoots. When profit-taking begins, it corrects violently. This cycle repeats again and again, and anyone who has followed silver for years knows this pattern well. One of the key levels silver interacted with today was the 50-day simple moving average. This moving average has acted as dynamic support since the uptrend began from the late November lows. When silver pulled back toward this level, sellers attempted to push price decisively lower, but they failed to create a sustained breakdown. That alone matters. In a true trend reversal, price does not respect key moving averages. Instead, it slices through them and keeps falling. That didn't happen here. Now let's talk about momentum indicators, because this is where many analysts start sounding alarms. The Relative Strength Index, RSI, cooled down to around 46, which tells us momentum has reset after being overheated. But here's the important nuance. An RSI cooling from overbought levels during a bull market is not bearish. It's healthy. It allows the market to reload energy for the next leg higher. Persistent bull runs do not move in straight lines. They breathe. The MACD, Moving Average Convergence Divergence, has also crossed below its signal line and dipped into negative territory with a deepening histogram. On paper, that suggests corrective pressure may continue in the short term. But again, context matters. In strong uptrends, MACD pullbacks often occur right before explosive continuation moves. These indicators are lagging tools. They confirm what already happened, not what's coming next. Another factor worth discussing is market positioning. Silver experienced a meteoric rise in a very short time frame. When that happens, leveraged traders pile in aggressively. Once prices stall, margin calls, stop losses, and algorithmic selling all kick in simultaneously. This creates exaggerated downside moves that look far worse than the underlying fundamentals justify. Once that leverage is flushed out, the market becomes stronger, not weaker. This brings us to the most overlooked aspect of the current correction: physical silver availability. While paper prices fluctuate wildly, the physical market continues to tighten. Large buyers are still accumulating, and physical inventory is not magically increasing just because futures contracts sold off for a day or two. When physical demand stays firm during price weakness, it creates a disconnect that eventually resolves to the upside. It's also important to remember that silver does not trade in isolation. Gold's strength today is a signal. When gold holds firm near all-time highs, while silver corrects, history shows that silver usually follows later. With far more force, gold leads, silver amplifies. That relationship has repeated across decades. So where does that leave us right now? In a market that is resetting momentum, shaking out weak hands, and testing conviction. This is uncomfortable, especially for newer participants. But discomfort is exactly what bull markets use to transfer assets from emotional sellers to patient holders. If technical indicators tell us how the market is behaving, then physical silver demand tells us why this bull run still has fuel left. This is where the conversation shifts from short-term noise to long-term reality, because no chart, no algorithm, and no trading model can override the laws of supply and demand forever. One of the biggest misconceptions in the silver market is the belief that price action reflects real-world availability. In truth, paper silver and physical silver are two very different markets. Futures contracts can be sold in massive quantities within seconds, but physical silver cannot be created or delivered that way. It must be mined, refined, transported, and stored, and that process is slow, expensive, and increasingly constrained. Right now, the physical side of the silver market is showing persistent tightness. Inventories are not rebuilding at a meaningful pace, even during pullbacks like the one we're seeing now. In previous cycles, price drops were often accompanied by a loosening of physical supply. This time, that isn't happening. Instead, dips are being met with real buying, not just speculative interest. Another factor that can't be ignored is who is doing the buying. We are seeing continued accumulation from high net worth individuals, long-term holders, and institutions that are not looking to flip silver for quick profits. These buyers view silver as sound money, not a trading vehicle. When silver moves into hands like these, it tends to stay off the market for years, not weeks or months. This is critical because every ounce that is removed from circulation tightens the system further. Unlike fiat currency, silver cannot be printed to meet demand. When large buyers accumulate physical metal and lock it away, the available float shrinks. Over time, this creates pressure that paper markets struggle to suppress indefinitely. There is also a psychological element at play here. When prices spike sharply, many people assume they've missed the move and step aside. But when prices pull back, conviction buyers step in. This creates a powerful dynamic where weak hands exit during volatility, while strong hands accumulate quietly. That transfer of ownership is exactly how major bull markets build their foundation. Another overlooked reality is industrial demand. Silver is not just a monetary metal, it is a critical industrial input. From electronics and solar panels to medical applications and advanced manufacturing, silver's role in modern technology continues to expand. Unlike investment demand, industrial demand does not disappear during corrections. Manufacturers don't stop needing silver just because futures prices dip for a few sessions. At the same time, mining supply remains under pressure. Years of underinvestment, declining ore grades, and rising production costs have limited the industry's ability to ramp up output quickly. Even if prices stay elevated, new supply cannot come online overnight. This structural imbalance is one of the strongest arguments for why silver's longer-term trajectory remains higher. What makes the current situation especially interesting is the disconnect between sentiment and fundamentals. Short-term sentiment has cooled, headlines have turned cautious, and technical indicators suggest consolidation. Yet beneath the surface, the fundamental drivers of silver's strength are not weakening, they're intensifying. This is often how the most powerful moves are built. Markets lull participants into complacency, convincing them that the excitement is over just before the next leg higher begins. Silver has done this repeatedly throughout history, and each time, the move that follows is stronger than most expect. Now let's move beyond price charts and sentiment and talk about something far more revealing: delivery data. This is where the silver market quietly exposes its stress. Because when traders stop rolling contracts forward and instead demand physical delivery, it changes everything. Over the past several years, deliveries on major exchanges, especially COMEX, have shown a clear trend. More contracts are standing for delivery, and they're doing it earlier. That may sound like a technical detail, but it's actually a red flag for a system built on leverage. Futures markets function smoothly only when most participants settle in cash. When physical delivery demand accelerates, it puts pressure on available inventories. What makes the current cycle different is scale. Compared to earlier years, the volume of silver being demanded for delivery has risen dramatically. In previous market environments, delivery spikes were isolated events, often tied to specific geopolitical shocks or financial crises. Today, however, elevated delivery levels are becoming persistent, not exceptional. This persistence suggests something deeper is happening. Participants are losing confidence in paper exposure alone. They want the metal. And that shift in behavior matters because the paper silver market is many multiples larger than the physical silver actually available for delivery. Another key point is inventory drawdowns. While registered and eligible silver categories can sometimes mask stress, the overall trend is clear. Replenishment is slow. Even during price corrections, inventories are not flooding back onto exchanges. That tells us that physical holders are not eager sellers at these levels. They're waiting. This brings us to the idea of price versus availability. Silver prices can move down sharply in short bursts due to futures selling, algorithmic trading, or macro headlines. But availability does not respond the same way. You can't algorithmically produce silver bars. When price drops fail to bring out sellers of physical metal, it exposes a structural imbalance. We're also seeing a growing divergence between spot prices and physical premiums. While futures prices fluctuate wildly, premiums on physical silver often remain elevated. This disconnect is not coincidence. It's a signal. It tells us that the paper price is not fully reflecting real-world conditions. Historically, when this gap persists, One of two things happens. Either physical demand weakens or prices eventually rise to reconcile the imbalance. Given current conditions, strong investment demand, rising industrial use, and constrained supply, the latter becomes far more likely. Another factor worth noting is timing. Many delivery demands are clustering around key contract months, creating pressure points in the system. When large numbers of contracts stand for delivery simultaneously, it forces exchanges and clearing members to manage risk more aggressively. That often leads to volatility, sudden price moves, and sometimes sharp intraday reversals. Exactly what we've been seeing. This is why days of extreme silver volatility should not automatically be viewed as weakness. In fact, they often signal stress beneath the surface. Markets under strain tend to behave erratically before resolving higher, not lower. There's also a psychological dimension here. When market participants see repeated episodes of delivery stress, it reinforces the idea that physical silver is valuable precisely because it is scarce. That belief feeds back into demand, creating a self-reinforcing cycle. Importantly, none of this suggests that prices will move in a straight line. Corrections, shakeouts, and violent swings are part of every major bull market. What matters is the underlying structure, and right now, that structure is tightening, not loosening. At this stage, it's important to address something that scares a lot of people out of the silver market: volatility. Sharp drops, sudden spikes, violent intraday swings. On the surface, it looks chaotic. But for silver, volatility isn't a weakness. It's actually a defining characteristic of every major silver bull market in history. Silver is a relatively small market compared to gold, equities, or bonds. That means it doesn't take much capital to move the price, especially when physical supply is tight and paper positioning is crowded. When momentum builds, silver moves fast. And when leverage players rush for the exits, it falls just as quickly. This is not abnormal. It's how silver has always behaved. What matters is where that volatility is occurring. Right now, we're seeing wild swings at historically elevated price levels, not at the bottom of a long bear market. That distinction is crucial. In past cycles, silver experienced its most violent pullbacks during bull markets, not before them. These moves are designed, intentionally or not, to shake out weak hands. Another important factor is leverage. The silver futures market is heavily leveraged, and when prices run too far too fast, margin requirements rise. That forces some traders to liquidate positions regardless of their long-term outlook. These forced sales often happen during low liquidity periods, amplifying price declines and making them look more dramatic than they really are. But here's the key point. Forced selling does not change the underlying fundamentals. It doesn't create new silver supply. It doesn't eliminate industrial demand. And it doesn't reverse the trend of central banks, investors, and institutions looking for protection against currency debasement. Volatility also plays a psychological role. It discourages new participants just as fundamentals are strengthening. Many investors wait for confirmation, but silver rarely provides comfort before making its biggest moves. Historically, the most powerful rallies begin when sentiment is mixed and confidence is fragile. We also need to talk about time horizons. Short-term traders experience volatility as risk. Long-term holders experience it as noise. If your goal is to trade every move, silver will test your discipline. But if your goal is wealth preservation and exposure to a finite, tangible asset, volatility becomes far less threatening. Another underappreciated aspect of silver's volatility is how it exposes stress in the broader financial system. Sudden spikes in demand often coincide with macro uncertainty, geopolitical tensions, debt concerns, currency weakness, or shifts in monetary policy expectations. Silver reacts not just to supply and demand, but to confidence itself. This is why silver often lags gold early in cycles and then outperforms dramatically later. Gold moves first as a monetary metal. Silver follows as both a monetary and industrial metal. When that transition happens, the price action becomes explosive and unpredictable. Right now, we are in that transition phase. Gold is holding strength. Industrial demand for silver continues to rise. Physical inventories remain tight. And yet, paper markets are struggling to price that reality smoothly. The result is turbulence. But turbulence does not mean failure. In fact, it often signals that the market is approaching a point where paper mechanisms can no longer fully suppress physical fundamentals. When that tension resolves, it tends to resolve quickly. When we step back and look at the silver market as a whole, the conclusion becomes much clearer. What we are witnessing right now is not the end of the bull market, but a stress test. A stress test of leverage, of weak conviction, and of a system that has relied on paper control for far too long. Despite sharp pullbacks and intraday volatility, silver continues to show one powerful signal that cannot be ignored: resilience. Each time prices are aggressively pushed lower, buyers step in, not just paper traders, but physical buyers. Coin shops, bullion dealers, and long-term holders continue absorbing supply. That matters far more than short-term candles on a chart. We also cannot overlook what is happening behind the scenes. Delivery data, rising industrial demand, shrinking above-ground inventories, and the continued erosion of confidence in fiat currencies all point in the same direction. These are slow-moving forces, but once they reach critical mass, price discovery accelerates rapidly. Silver does not move gradually in the later stages of a bull market. It moves violently. Another key takeaway is behavioral. Bull markets are designed to feel uncomfortable. They test patience. They punish overconfidence. They lure people in at highs and scare them out at lows. Silver is especially ruthless in this regard. That's why it has a reputation for being untradeable for many, but also why it has historically delivered outsized gains for those who understand its nature. For long-term stackers and investors, the noise we see day to day is largely irrelevant. The real story is measured in ounces accumulated, not dollars fluctuated. Silver's role as sound money, an industrial necessity, and a strategic metal has not changed. What has changed is awareness, and awareness tends to arrive suddenly. We are also entering a period where macro risks are stacking, not fading. Government debt continues to expand. Monetary policy credibility is fragile. Geopolitical tensions remain unresolved. These are not conditions that historically lead to sustained weakness in hard assets. If anything, they increase the urgency for tangible stores of value. This is why many seasoned investors view volatility not as a warning sign, but as confirmation. It suggests the market is under pressure. It suggests opposing forces are colliding. And when that happens in a market as small and essential as silver, outcomes tend to be dramatic. That does not mean the path forward will be smooth. There will be pullbacks. There will be sharp corrections. There will be days that test conviction. But cycles are not defined by comfort. They are defined by fundamentals. And those fundamentals remain firmly intact. As always, the most important decision is aligning your strategy with your goals. Short-term speculation and long-term wealth preservation are two very different games. Knowing which one you are playing changes everything. Before we wrap up, it's important to be clear and responsible. Financial disclaimer: the content shared on Silver&Metal IQ is for informational and educational purposes only. Nothing discussed in this video should be considered financial, investment, or trading advice. Precious metals markets can be volatile, and all investments carry risk. Always do your own research and consult with a qualified financial advisor before making any investment decisions. Past performance is not indicative of future results. That's going to do it for today. If you found this breakdown helpful, make sure to share your thoughts in the comments and let us know how you're navigating this market. Thank you for watching, and we'll see you next time right here on Silver&Metal IQ.